Hey everyone, welcome to Unit 14 of Math. In this topic we'll be talking about the short-term and medium-term financial management. So there's three subtopics. So number one is understanding the role of short-term and medium-term finance in the capital structure of a business. And then basically the second and third subtopic is doing a deep dive into each of those. So short-term and medium-term finances. So the only one we're not going to be talking about in this module or in this particular chapter is long-term financing. So let's first talk about the split between short-term and medium-term financing. So the main distinction is that short-term is funds required for less than 1 year, but in operation it's usually between 3 and 6 months that are used to cover the day-to-day operating needs of the business. So for example, your trade credit, your bank overdrafts, your credit cards, your debt factoring, your invoice discounting. So that's all the stuff that you're not going to hold for more than 12 months, right? You're not going to have a credit card bill for more than 12 months, for example. Then the next stage up is the medium-term financing, and that's for funds that are required for a period between 1 and 5 years. For example, you might have a lease and hire purchase arrangement, you might have a medium-term commercial loan, and so forth. So these, and the long-term financing, which we'll talk about in the next chapter, which is business funding number 2, and we talk about the different types of long-term finance. So we'll get to that later. But generally, these two types of financing, so your short-term and your medium-term, they're a lot easier to obtain from the banks, purely because the bank's going to get their money back in a shorter period of time, and usually the interest rates are a little bit higher as well. So it's a bit easier for companies to actually get these types of loans. So some examples of medium-term financing is term loans. For example, it's got a fixed period of 5 years. Leasing and hire purchases. So that's basically, when you buy equipment, but you just pay installments toward it, but you actually earn it towards the end of the lease period. So the cost versus the risk in financing. So short-term debt is cheaper than long-term debt, as it's less risky to the lender. And the cost of borrowing will differ for all organizations. So the risk profile of an organization and how it's perceived by the lender relative to the market rates will determine the cost of debt. So there's two types of strategies. There's aggressive and there's conservative matching strategy. So what a matching approach is basically it's matching the length of the maturity of the source of finance with the lifetime of the assets being funded. So for example, cash inflows created by the assets are matched against the cash outflows required to service the funding of those assets. So for example, if you've got a finance lease on a particular piece of machinery, the bank might do a cash flow forecast of the extra cash being generated by that particular asset versus what you'd receive, what you have to pay on the loan. Same thing if you're buying a business, they'd work out DCF on the dividends, or if you're buying an investment property, they might look at the weekly rental. So short-term financing is used to fund short-term fluctuating current assets, and long-term financing is used to more permanent aspects of the current assets. So that's the other element of this. So if this is an asset which is going to produce income in a long period of time, for example, a rental property might be a long-term finance, or a building, commercial property. Whereas, if you're just using the financing for working capital, like purchase of inventory, that's going to be a very short-term kind of purchase. So therefore, your funding will also match that, and that's basically the matching approach. And you can also adjust that strategy to be either more aggressive or more conservative by changing the mix of the financing. So there's a table down here from the CSG talking about the strategy, aggressive or conservative, and the financing mix of each. So for example, in an aggressive strategy, this would match your your short-term financing is used to fund both fluctuating and permanent current assets. So what it's saying is you don't have just short-term financing matching current assets. You might have short-term financing funding both longer-term assets as well as short-term assets. So that's aggressive. Conservative, on the other hand, is it's very much matched against the time period. So for example, all assets are funded by long-term sources, so it's a bit more conservative. So the features of the aggressive financing mix is the package is flexible and capable of being adjusted to match the level of fluctuating current assets. And the strategy is riskier in terms of the stability of the funding. The features of the conservative strategy is that the servicing and repayment patterns are structured and the facility cannot be withdrawn at short notice. The financing package is typically more expensive to service than an aggressive strategy. The package is less flexible and typically cannot exactly be matched exactly with the nature and requirements of the fluctuating current assets, and the strategy is less risky. So now let's talk about the different funding types. So sources, you could say, non-financial institutions and financial institutions. So non-financial institutions are generally your unsecured finance, and financial institutions are generally your secured finance. And what we say by secured is basically whether or not the finance is actually against a particular asset. For example, if you're buying a house, you'll get a mortgage and the mortgage will be against the property. So if you can't pay your mortgage anymore, the bank will come in and take the asset. So that's secured finance. Unsecured finance is basically where it's not secured against any particular asset, but that means there's more risk for the bank, and that generally means that the borrower will pay a lot more in interest to match that risk level. So some examples from a non-financial institution is trade credit, extended payments, consignment stock, accrued wages and taxes, whereas secured finance are bank overdrafts, credit cards, debt factoring, and invoice discounting. So let's do a deep dive of some of these different types of debt, although most of you will probably know about them already. So trade credit is one of the most flexible sources of short-term financing. It's basically debt funding from trade suppliers. It's basically a way of manipulating your working capital so that you actually get some more cash to play with. So for example, trade credit is a way of you might go to a supplier and say, I want some inventory, but instead of actually paying cash for it, you might actually receive it without actually making immediate payment. And you might put it on payment terms. Generally, it's between 15 and 90 days. And after that period, you need to pay the invoice. So that's why it's actually classified as short-term financing, is because you're effectively borrowing that money. Whilst it's not money, it might come in the form of inventory or, but all of those items can be liquidated to money fairly easily. So hence, it is a form of financing. So it usually arises automatically in the course of business because it's part of working capital. And it's quite a cheap source of finance if the business is able to repay its debt before the agreed repayment debt. Generally, if you repay it within the agreed terms, you're not going to have any interest on top of that. But if you pay it late, then you might have late penalties and additional interest on top of that. So the cost of the trade credit agreement is determined by the late penalty payment and early payment discount. But generally, during that period, you're not paying any interest. Extended payments is another form of short-term credit. So it's basically when you negotiate payment terms with a supplier, and you say, look, extended payment terms. Let's just say you've got a supplier and you have to pay on 90 days, and you might go to them and say, oh, look, business is a bit tough. Can we just extend that to 120 days? So basically, you're going to get an extra 30 days of free money based on what you normally have. And you just basically, the interest or the return that the borrower has to pay on that is usually the interest rate on the loan, which can be annualized in the same way as settlement discounts. Consignment stock is stock that's held by the customer and owned by the supplier. So it's kind of similar to this trade credit, but up here, except the person in trade credit arrangement, the person borrowing it, or the company, actually owns the stock or whatever's being received, whereas consignment, it's the supplier who still owns the stock, but the customer is allowed to hold it physically. They're able to hold possession of it. So this allows the consumer to sell or consume directly some of that stock, and the customer is deemed to have purchased the stock when it is sold or consumed, and this is when a payable is created. And it's at the end of the agreed period, any unused stock is returned to the supplier. So this allows for delay in payment, it reduces the cost of capital tied up in stock, and it lessens the risk associated with over-ordering stock. And then of course you've got your accrued wages and taxes, and that's basically, for example, your employer might withhold, just as an example, they might withhold amounts from your salary, and that'll just sit on the balance sheet for a month or so until the company has to lodge their BAS or their GST remittance, and they'll submit that to the government and pay it then. But during that time, that means they got a month where they actually hold the money, which technically isn't their money. So in a sense, that's a form of short-term financing. So let's move on to the other side of the equation, so the secured finance, because all of the ones above were unsecured, typically. So bank overdraft is basically where you might have an account with a bank, but the bank actually allows the business to run that account into deficit. So you might have a savings amount and you put your money in there, so you've got $10,000 in there, but the bank will actually allow you to draw that down to negative $10,000 if you've got some inventory that you have to purchase and so forth. So an overdraft typically occurs, well, it does occur when the money is withdrawn from the bank account and their balance falls below zero. That's when it becomes an overdraft. So if the amount is within an agreed limit, so the bank might say you can go into overdraft up to $20,000 a month, and after that point, we're going to charge you interest at an agreed amount. However, if there's no prior agreement, you might just get charged interest, etc., as soon as it hits below zero. So overdrawn accounts are usually at call, so the bank can require payment at any time. And businesses typically like them because they're very flexible and it's a convenient source of short-term finance because you don't necessarily need to hold the cash at any point in time. And it allows for the unexpected nature of businesses. If you've got a random payment, all of a sudden you just go into overdraft and you're sorted. So some of the key features of an overdraft facility, so cost. So it's usually charged based on the daily balance of the account. It's flexibility. It's very flexible because you can draw down whenever you want. The fees, so you normally have establishment fees to set up the account and maybe paid on an annual basis, via an account service fee. But you might have penalty fees, which is a key area of risk, especially for a smaller organization. If the company inadvertently breaches the agreed facility limit, and then the penalty fees can be quite severe. And then security. So some businesses are allowed to have an overdraft without security, but in most cases you do actually need a security. So the next type of secured finance is credit cards, which are fairly self-explanatory. Most people would have one of these. It's a card that you can use for personal purposes, and businesses have them as well. So it's just another way of basically borrowing short-term debt. Usually the period that it's free credit is up to 55 days, and after that you need to pay down the balance. And if you don't pay down the balance at that point, you're going to have interest rates, but the interest rates are very, very high, right, compared to some of the other forms of financing. It might be up to 20%. So debt factoring is another form, and that's basically debt factoring is basically when you sell your trade receivables. So let's say you've got trade receivables, you've got your amounts owing from customers at 30 days old, 60 days old, 90 days old, and so forth. So so that money is yours that you're entitled to as the company, but you're not 100% sure you're going to get it, and you're not sure when you're going to get it. So anything over 90 days might be bad debt, for example. There might be a 5% chance that you might receive 90 days. Whereas the 30-day debt, there's a higher chance of receiving it, but you don't get to control when it comes in. And some companies, they like having that control over when the cash is coming in, so they can plan for cash outlays and things like that. So one way to get around that is to actually sell your trade receivable to an independent company. So that independent company usually pays a significant discount on what the value is because they're inheriting the risk of they might not receive the money. So you're basically, as the company, you're selling it at a discount, but in exchange you're getting the certainty of getting the money up front. So it's a way of basically converting your working capital into an amount owing. So typically receivables are bought around 80%, and the remaining 20% is your fees and interest when customers pay. So the conditions and charge, you might have interest on the total amount, you might have fees like administrative and collection fees. You might have lower reduced payment on poorer quality, receivables because they're too risky for the factoring company. And you might have non-recourse, so you have to accept that some customers will not pay, therefore you don't actually get money for it. So let's talk about the nature and features of short-term financing, which is the second subtopic. So now we're just talking about short-term financing. So invoice discounting is closely related to debt factoring. And this is basically where invoices, rather than the sales ledger, are given to the finance house, which is the external company, in return for immediate payment of up to 90% of the face value of the invoices. So the company retains control of collection and management of the invoices, but when the due date is reached, the company hands over the total invoice amount to the finance house in exchange for the remaining 10% less interest and service charges. So unlike debt factoring, customers have no contact with the finance house. So the arrangement is normally with recourse, so the company takes the risk that the customer may pay or not at all, but still might pass the full amount to the finance house on the due date regardless of whether it has been received. So this is different to factoring in that the company still retains ownership of all of the invoices, whereas if it's factoring, the company sells ownership of that accounts receivable to the factoring company. Now, the factoring, companies might not want to do factoring because potentially, if the factoring company goes around and follows up customers, it might cause them distress, and that potentially might lose the company future sales, right? So they may prefer just to do the discounting and invoice discounting. And what this does is it has the same benefit of factoring in that the company gets the value, albeit discounted value, of its accounts receivable up front, right? So that helps prevent the cash flow issue. However, the company still has to follow up on those debtors and chase that up and so forth. So basically it's a trade-off between certainty of cash versus getting that cash up front, versus you still have to go and follow them up at a reduced amount as well. Okay, so let's talk about chapter 3 now, which is about the medium-term financing. So this is, if you remember, this is financing between 1 and 5 years period. So for example, term loans, leasing, and hire purchases. So a term loan is when a borrower enters into a contract with a lender to repay the loan over a specified term. These are usually at fixed or variable interest rates. So it's kind of similar to how you would look at a mortgage, for example, except it's not a mortgage. Mortgage is a specific loan where it's 20 or 30 years against a property specifically, or of some sort of property, whereas a loan might not be for any specific purpose, could just be a business loan. It's just the bank lending the money for a fixed period of time, usually a short period of time. Well, when I say short, I mean medium period of time. And it's the same, either fixed or variable interest, and the borrower just pays back principal and interest, same as a mortgage. So there's two types of loans. There's the intermediate term loans, this is less than 5 years, and then there's long-term loans, which is more than 5 years. And the bank, of course, similar to a mortgage, they might charge fees on the loans. For example, establishment fees, ongoing line of credit or service fees, and so forth, on top of your principal and interest repayments. So this is the formula to actually calculate how much a loan repayment's actually going to be. So it's basically the present value of interest factor of an annuity, which is the value of an annuity of $1 in arrears at an interest rate of I over n periods. So this is the present value of the loan, PV over here. So this is the value of the loan in discounted today's dollar terms. That's equal to the payment, so the annuity payment at the end of each period, times the discount factor at an interest rate of I over n periods. And if you're not quite sure how to calculate that, there's this formula down here which you can just substitute in there, which is basically 1 minus, in brackets, 1 plus I, which is the interest, to the power of negative n, which is the number of periods, divided by the interest rate. So that'll calculate that, and that'll tell you the value of the loan in present value terms. Okay, so then move into the next type of medium-term finance, so leases and finance leases. So this is basically when you enter this agreement. It conveys or gives you the right of use for an asset for an agreed period of time in return for regular payments. But at the end of it, you typically will take ownership of it. So there's two parties to this. There's the lessor, who's the owner of the asset, and there's the lessee, who's the user of the leased goods or property. So that at the end of the lease agreement, the lessor may allow the lessee to purchase the asset, and the lease payments are made in advance, i.e. at the beginning of the period, and this contrasts with loan payments which are made in arrears, i.e. at the end of the period. So this will be set out in a lease agreement, which is a legal document setting out the duties and obligations of the lessor and lessee. So there's typically two types of lease agreements, which you might remember from Fin. So there's the finance lease, and then there's the operating lease. So a finance lease is a long-term leasing agreement. Typically, you'd expect to own the asset at the end, whereas the operating lease is more of a rental agreement, right? So you don't necessarily own the asset at the end of the lease. So the impact on the financial statements depends on whether a lease is classified as a finance lease or operating lease. And remember, the treatment of leases has recently changed with IFRS 16 if you've done the Fin module, but we don't need to go into that level of detail here. So we're going to skip over this. Okay, so let's move on to the advantages of leasing. So with leasing, as opposed to purchasing, you may have a small initial outlay for the lessee compared to the asset purchase, which improves your overall liquidity of the business. It's typically easier and quicker to arrange than if borrowings were required to purchase an asset outright. And of course, this may avoid the restricted covenants of doing so. And C, this source of finance provides relative certainty. As long as contractual payments are made, the finance cannot be withdrawn. The source of finance is often available when other more structured loan facilities are not. And the fixed rate interest payments are often agreed as part of the contract, allowing for more certainty in cash flow forecasting. And finally, there are tax advantages associated with the tax deductibility of lease payments as opposed to buying an asset outright, which you just appreciate. So hire purchasing is fairly similar. It's probably more of the finance lease side. It's a means of purchasing the goods by payment of installments. So you typically do this for purchase of, more fixed assets, equipment, cars, commercial vehicles, business equipment, and so forth. So the hirer has the use of goods while payments are being made, but doesn't become the owner of the goods until the last payment is made. And when the total price of the goods and the interest charge have been paid in full, the hirer takes ownership. So the features of the hire purchase financing are it's usually flexible contracts. It's usually got a residual value, which is like a last bigger payment at the end, maybe placed on the contract, which allows installments over the term of the contract. C, the interest rate and monthly repayments are fixed. D, the finance is usually secured against the asset, allowing lower interest rates. And then finally, E, the tax treatment may be different from the accounting treatment. So let's just quickly recap what we went through, because that's the end of the topic. Fairly straightforward topic. I'm sure many of you already know what we've discussed in this. So first of all, we basically just talked about short-term and medium-term financing, and we did a deep dive in each of them. So the key takeaways are the time period of each. So short-term's usually less than 12 months, whereas medium is between 1 and 5 years. Generally, banks prefer short-term financing because they get their money back, so the risk is a bit lower. We talked about the different types which fall within each. So for example, trade credit on the non-financial institutions or bank overdrafts on the financial institutions. And we all talked about how the financial institutions, the short-term debt's usually secured, whereas the non-financial institutions, it's usually not secured. And if you have non-secured debt, it's usually a higher interest rate. Whereas medium-term, longer period. Some examples are term loans, leasing, and hire purchases. So we talked about those. We talked about some of the different types of each of these, which I'm sure a lot of you are already aware of. We talked about the loan repayment formula, which basically you can use to calculate the present value of a loan. We talked about what leases were, including the advantages and disadvantages, and that was the end of the chapter. So pretty easy and quick chapter. Let's finish off math in the final chapter, which is business funding 2 in the next chapter, where we talk about long-term financing.